Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into BigBear.ai Holdings, Inc., BBAI, a company that sits right at the critical intersection of national security, cutting-edge artificial intelligence, and some seriously volatile stock market action.
This is a deep dive at a moment of, extreme tension for BBAI. Their strategic direction, this massive AI opportunity, is currently fighting a pitched battle against their cold, hard financial reality.
Right, so let's just lay out the core thesis right up front for everyone. What's the central conflict here that you see?
Well, it's a huge strategic bet. BBAI is executing a high-stakes strategic bet on the $250 million Ask Sage acquisition and its $715 million liquidity war chest to capture the generational opportunity presented by $16 billion in OB3 AI funding.
Okay, so that's the massive potential upside.
Exactly, but, and this is the huge but, this enormous potential is offset today by a severe 20% revenue decline, a move to negative $9.4 million adjusted EBITDA, and the severe shareholder dilution required to finance this entire high-risk growth strategy.
That thesis sets up an incredible conflict. We're looking at a company that is simultaneously, in existential distress operationally, yet it's armed with enough cash to completely redefine its future.
It's a classic Wall Street story.
So our mission today is to synthesize the Q3 2025 financials and that critical Ask Sage acquisition announcement. We need to provide you, the listener, with a clear, impartial investment thesis that rigorously balances the company's strategic importance in defense modernization against those current, very real structural and financial headwinds.
Let's get into it.
Let's start with the immediate fight. The Q3 2025 financial report, which shows a really severe operational contraction. This feels like the first major piece of evidence suggesting that BBAI's foundation is currently shaky, regardless of their strategic offense plans.
The raw numbers, they paint a picture of significant short-term instability. Our core data point here is the top line. Revenue decreased a steep 20% year over year.
20%.
20%. It fell substantially to just $33.1 million in Q3 2025, and that's compared to $41.5 million in the same quarter last year. When a company is in purported high-growth sector like government AI, a 20% annual contraction it's a massive shock.
That is completely counterintuitive to the narrative surrounding AI spending. So why this sudden and dramatic decline? Was there a major contract loss?
Management was very specific about the causality. They attributed this decline primarily to lower volume on certain key Army programs.
Okay.
Crucially, they noted major disruptions stemming from the Army's ongoing large-scale data architecture modernization efforts. So this isn't a contract being lost to a competitor. This is the client, the Army, tearing up the digital infrastructure and rebuilding the foundation.
So if the client is essentially replacing the building while BBI is trying to conduct business inside it, the work volume just naturally slows down or pauses entirely.
It has to.
That causes project delays, scope creep, and just unexpected friction.
Precisely. For a service-heavy contractor like BBAI, when the foundational systems of your largest customer are in flux, it creates immediate, painful revenue dips. And this short-term shock was severe enough that it directly impacted their forward-looking guidance.
So it's not a one-off?
Not at all. It contributed to the full year 2025 revenue forecast being cut substantially to between $125 million and $140 million. So, that lands the midpoint expectation at a much lower $132.5 million. This revised guidance signals that the Army disruption wasn't a one-quarter anomaly, but something management expects to persist through the year-end.
Okay, shrinking top line is bad, but let's look at the bottom line health. What about operational profitability? We usually measure that using Adjusted EBITDA.
The profitability story is equally challenging, I'm afraid. Adjusted EBITDA, which, it gives you a cleaner view of core operational health, it swung sharply negative. We're talking negative $9.4 million in Q3 2025.
Wow. And what was that a year ago?
This compares disastrously to the comparable period in Q3 2024, when they actually managed a slightly positive $6.9 million. So that is a massive operational reversal of over $10 million in just 12 months.
Was this purely a function of lower sales volume, or did their cost structure actively work against them?
It was both. We saw margin compression first. Their gross margin fell to 22.4% in Q3 2025, down from 25.9% a year prior.
Okay, and the reason for that?
Management pinned this on a contract mix that skewed toward a higher proportion of lower margin work during the quarter. They were basically forced to take on or execute less profitable contracts to, keep the lights on and utilize capacity.
But the real eyebrow raiser for me is the massive surge in overhead costs, their selling, general, and administrative expenses, or SG&A. If sales are shrinking and margins are compressing, SG&A should ideally be under tight control.
Instead, it did the opposite. SG&A expenses surged dramatically to $25.3 million in Q3 2025, up from $17.5 million in Q3 2024.
Wait, what's that percentage-wise?
That is an astonishing 44.4% increase year over year. This is the financial manifestation of their go-on-offense strategy, colliding head-on with their shrinking revenue reality.
Hold on, so revenue's dropping by 20%, but the management team is increasing its overhead by almost 45%. I mean, that suggests a real lack of operating discipline, or at a minimum, a decision to just prioritize investment and M&A integration preparedness over quarterly efficiency. How do they justify that?
They tried. They itemized the surge into several distinct buckets, attempting to frame it as a strategic investment. They cited $2.0 million attributed to non-recurring strategic initiatives.
Which is code for M&A costs.
Exactly. M&A costs, due diligence, and structuring fees related to the Ask Sage deal. Another $1.4 million was pumped into increased marketing efforts, including brand visibility initiatives like their sports partnerships.
Okay.
And finally, and most substantially, there was a $4.3 million increase in SG&A labor and fringe costs, which indicates pretty aggressive hiring in their sales, growth, and general corporate staff.
So they are investing millions into infrastructure, talent, and M&A planning right now to pursue future growth, even though it guarantees deep operating losses and, frankly, punishing negative operational leverage today. That is a high-stakes gamble on the success of their pivot.
It absolutely is. I mean, these investments are necessary to execute the pivot, but they are clearly the primary driver behind the negative operational profitability we see in Q3, magnifying the effects of those contract disruptions.
Now, we have to address a point that can easily mislead investors.
Yeah.
The reported GAAP net income. Despite everything we just discussed, the 20% revenue drop and the negative Adjusted EBITDA BBAI reported a slight net profit. We have to explain why this is completely divorced from their operational health.
This is so critical for understanding their complex financials. They reported a $2.5 million GAAP net income for Q3 2025. This profit was not generated by selling AI services or software.
Right.
It was solely driven by a massive $26.1 million non-cash derivative gain.
Okay, so let's break that down. What exactly does a non-cash derivative gain represent? This is where a lot of people's eyes glaze over.
Right. It stems from the complex capital structure BBAI uses, specifically the fair value remeasurement of their convertible notes and warrants, in this case, the 2029 notes conversion option.
So they have debt that can convert to stock.
Exactly. And when BBAI issued these convertible notes, the conversion feature itself was classified as a derivative liability on the balance sheet. According to accounting rules, this liability must be remeasured every single quarter based on inputs like the stock price, interest rates, and volatility.
So if the fair value of that liability decreases for whatever reason, the company records a non-cash gain on the income statement, correct?
Precisely. If the underlying stock price volatility decreases, or if other inputs change in a way that makes the option less valuable to the holder, or if interest rate movements affect the liability valuation, the liability on their books shrinks. And when a liability shrinks, it is recorded as a massive non-cash income statement gain. The $26.1 million gain is an accounting entry. It's a paper adjustment driven by the complexity of their debt structure, not by operational success.
So if we strip out that non-cash accounting magic, the actual core operational business lost, what, roughly $23.6 million in the quarter?
That is the crucial takeaway. Without that non-cash accounting adjustment, the operational picture remains deeply, deeply negative. And it's why sophisticated investors focus heavily on metrics like Adjusted EBITDA and cash flow from operations, which show the true health of the core AI business rather than being swayed by headline GAAP net income figures that are influenced by financial engineering.
All right, so let's move to the second major structural issue facing the company. The limitations inherent in their business model, which are compounded by a historical pattern of governance and execution risk.
This is key. The low margin is not temporary. It's a structural ceiling on the business. Let's reiterate that 22.4% gross margin in Q3. This needs to be put in sharp context against their pure software peers.
When we talk about AI companies serving the defense sector, the automatic benchmark is Palantir, or even general enterprise SaaS players, What margins are they achieving?
It's a different universe. Pure software or platform-based software as a service SaaS companies typically boast gross margins in the 70% to 90% range. Palantir, for example, consistently operates in the high 70s or 80% range for their platform deployments.
So 70 to 90% versus 22.
Yes. BBAI's margins sitting consistently in the low to mid-20s is fundamentally different, and it dictates a completely different valuation multiple. This is really the heart of BBAI's structural problem.
So why is BBAI stuck down there? Why can't they leverage the high margin profile we expect from an AI company?
It comes down to their historical approach, the service-heavy model. BBAI's revenue is largely rooted in providing custom-tailored, service-heavy solutions for specific government contracts. They are not selling a repeatable software license. They are selling specialized labor, integration services, and bespoke consulting to solve unique customer problems within these massive, complex government ecosystems.
This means they need to deploy expensive, specialized engineers for every single contract, correct?
Yeah.
It doesn't scale.
Exactly. It requires significant specialized talent, ongoing customization, and a high cost of goods sold, salaries, security clearances, integration costs, which eats up profit immediately. Plus, many government contracts are structured as cost plus or fixed price for tailored services. This structure inherently caps BBAI's profit potential compared to a high-margin, flexible SaaS structure where the marginal cost of selling one more software license is near zero. The service model prevents them from achieving the high scalability and premium multiples that the market grants to pure software platforms.
And beyond this structural margin issue, the financial picture carries let's say, a historical taint from past execution failures that raise questions about management's forecasting and M&A discipline.
We can't just ignore the past here. We have to recall the massive $70.6 million goodwill impairment charge that was recorded earlier in Q2 of 2025. Goodwill, for the audience, represents the premium paid for a company above the fair market value of its tangible assets, so you're essentially paying for expected future synergies.
So when they take its $70 million impairment charge, what is the clear signal to the market?
The clear signal is that management concluded that the expected future financial benefits, likely from a prior acquisition like Pengium, are simply not materializing as they originally forecasted. It suggests a historical weakness in acquisition strategy, due diligence, or maybe operational execution post-acquisition. It's a very painful acknowledgement that they effectively overpaid.
And compounding that operational question mark is the persistent and pretty serious issue regarding transparency and control over their own books.
This is perhaps the most serious governance issue. We have to detail the previously reported material weakness in internal controls over financial reporting. Now, this is a deficiency significant enough that it could lead to material misstatements in their financial reports.
And they've had issues before, right?
They've already had past errors requiring restatement, specifically related to those very convertible notes derivatives we just discussed.
So what was the finding in this latest Q3 report regarding these controls? Did they fix it?
No. The report confirmed that as of September 30, 2025, management concluded disclosure controls were still not effective. Now think about that. When a company is executing a complex financial strategy, raising hundreds of millions in equity, managing complicated derivative accounting, and executing a major $250 million M&A deal, having a persistent, documented material weakness in internal controls is a profound red flag.
Why is the governance failure so critical right at this moment?
Well, it raises significant questions about the reliability of their financial reporting during this period of rapid, complex expansion. It impacts auditor reliance. How comfortable are the auditors with certifying future reports? And critically, it raises red flags for M&A due diligence. If their own internal controls are weak, how confident can the market be that the cash flow and financial models they're using to justify the $250 million Ask Sage purchase are perfectly accurate? This vulnerability just adds friction and skepticism for sophisticated investors who are analyzing the thesis.
We've established the severe financial and structural headwinds. Now let's shift to the offense, the strategic pivot. How is BigBear.ai spending its hard-won capital to try and overcome the structural weakness and that 20% revenue contraction?
This strategic pivot is the sole justification for the aggressive dilution and the operating losses we've been talking about. The centerpiece is the definitive agreement to acquire Ask Sage, which was announced late in the quarter for $250 million.
$250 million. And the structure is heavy. It's $140 million cash up front and another $110 million in either cash or stock, which is dependent on the 20-day VWAP prior to closing.
So they are betting $250 million that this acquisition can fundamentally change their structural margin profile. What exactly is Ask Sage?
Ask Sage is an enterprise-level generative AI platform, often described as an LLM wrapper.
Okay, a wrapper. Well, what does that mean for, say, a general in the Pentagon?
Think of it as the secured layer that sits on top of various large language models, whether they're commercial or government developed, that allows organizations to use powerful AI safely and securely. It provides secure distribution of AI models and, critically, something called agentic capabilities.
Okay, we need to pause there. Agentic capabilities, that's a key term in next-gen AI. What does that mean in the context of defense and government?
An agentic AI is not just a chatbot that answers a single question. It is an AI system that can autonomously plan and execute complex, multi-step tasks to achieve a user's goal. In a government or defense environment, this means the AI can receive an objective, break it down into subtasks, interact with multiple classified data systems, analyze the results, and formulate a final action or recommendation, all without constant human input.
That functionality, especially for decision-making in classified or highly regulated environments, is incredibly powerful.
And that leads to its core competitive advantage: security and accreditation. Ask Sage is purpose-built for defense and highly regulated industries, enabling organizations to, and I'm quoting here, safely use the best AI models with sensitive or classified data. The key differentiator that makes it worth $250 million is its security clearance. It holds FedRAMP high accreditation.
That FedRAMP high designation is a massive competitive moat in the federal space. Why is it such a high barrier to entry for other companies?
Achieving FedRAMP high accreditation for a new complex Gen AI platform is often a multi-year, multi-million-dollar bureaucratic hurdle. It certifies that the platform meets the government's most stringent security requirements for handling the most sensitive, unclassified data. So by acquiring Ask Sage, BBAI effectively buys its way past years of bureaucracy.
They're buying speed to market.
Exactly. The CEO underscored this point, stating BBAI will be deploying and scaling their Gen AI solutions while competitors are still building and working through certification. That time-to-market advantage in the rapidly evolving AI arms race is priceless in defense tech.
So they instantly gain the technology, the security moat, and a massive existing customer base that is already using Gen AI securely.
That's the trifecta. Ask Sage already supports over 100,000 users across 16,000 government teams and 27 agencies, including a presence in the US VA hospital system. This provides BBAI with an immediate, pre-accredited channel for cross-selling its existing mission applications and integration services directly into a secure customer base that is ready for high-margin software.
Let's translate this strategic pivot into measurable impact. What does this $250 million purchase do to BBAI's shrinking top line?
The growth profile of Ask Sage is the direct antidote to BBAI's organic contraction. Ask Sage is expected to deliver $25 million in 2025 annual recurring revenue, ARR. Now, that's a non-GAAP figure, but it represents a phenomenal 6x year-over-year increase from its 2024 ARR.
Six-fold growth. That's the kind of number that commands premium multiples. When we stack that against BBAI's projected revenue, what kind of lift does it provide?
When you measure it against BBAI's anticipated $125 million to $140 million 2025 revenue guidance midpoint, this acquisition alone promises to deliver somewhere between 17.8% and 20% top-line growth once it's fully integrated.
So in essence, management is using $250 million to buy back the equivalent of the revenue they lost in Q3.
But they're replacing low-margin service work with high-growth, high-margin software ARR.
That is the compelling synergy. But let's address the elephant in the room that any critique would highlight: the integration risk. They're trying to merge a fast-moving, high-growth, high-margin LLM platform with a legacy, low-margin, bureaucracy-focused service culture.
The integration risk is immense, and it is a major operational challenge for 2026. Successfully integrating Ask Sage requires more than just mixing the balance sheets. It means fusing two completely different corporate cultures. The high AR growth, talent-intensive LLM development side needs speed and flexibility, while BBAI's core business relies on long, structured government contracting cycles. If BBAI's service-heavy bureaucracy stifles the Ask Sage talent or development pipeline, they risk destroying the very growth and margin profile they paid $250 million for.
And what about the key talent? I know the founder's coming over.
Yes. The founder of Ask Sage, a man named Nicolas Chaillan, is joining BBAI as the new Chief Technology Officer. This signals a deep integration of talent and vision at the very top, which definitely mitigates some of that risk. But the operational challenge remains. How do you retain and incentivize the high-margin software engineers crucial to Ask Sage's 6x growth profile when they are absorbed into a much larger, lower-margin service organization?
This strategic offense requires immense capital, which leads us to the source of their firepower, the liquidity war chest and the market tailwinds they're counting on.
The biggest piece of the bullish case is the capital structure. As of September 30, 2025, BBAI reported a record $715 million in cash and investments. That includes $456.6 million cash and substantial liquid investments.
For a company that only forecasts $132 million in revenue for the entire year, that is a massive war chest. It provides runway and credibility for their M&A strategy.
It's staggering. But as we've repeatedly stressed, this cash did not come from profits. It came from the market, and at a massive cost to existing shareholders, dilution.
A huge cost.
The liquidity came at the explicit cost of aggressive dilution through their at-the-market or ATM equity offering program. We have to detail the sheer scale of the capital raise in Q3 alone. They raised $337 million in gross proceeds from the sale of a staggering 65 million shares of common stock.
65 million shares sold in one quarter while the underlying operational metrics were collapsing. That sounds like management taking full advantage of market enthusiasm for AI to shore up their balance sheet, knowing the underlying business was bleeding cash.
It is a textbook move, selling stock into strengths to fund weakness and future acquisitions. And those 65 million shares were sold at an average gross selling price of $5.18 per share. When you combine that with prior raises, they have issued over 142 million shares through the ATM program in just the first 9 months of 2025, generating over $637 million in gross proceeds. This is the explicit cost, the dilution required to fund the $250 million AskKD acquisition and finance their continued negative operating cash flow.
Now, let's pivot to the generational market opportunity they are trying to capture, which theoretically justifies this costly capital raise and dilution.
The strategic justification is the alignment with major federal spending. BBAI is, perfectly positioned to align with the $16 billion in OB3 AI funding allocated specifically for military AI autonomy.
We mentioned OB3 AI funding, that $16 billion figure. Can you give us a little more context on the historical urgency behind this?
Sure. This funding is part of a much larger legislative effort. The $150 billion DoD allocation, often referred to as the One Big Beautiful Bill Act, which represents an unprecedented effort to modernize the military's digital backbone and leapfrog competitors in the AI arms race. The $16 million specifically targeted for OB3 AI funding signals that military autonomy and AI deployment are no longer discretionary budget line items. They are essential national security imperatives. BBAI, with its existing clearances and defense focus, is directly targeting what the CEO calls a transformative level of investment.
And BBAI's existing government work shows resilience, suggesting they are already deeply embedded in mission-critical operations.
That's a key point that counters some of the financial instability. Management noted that over 80% of BBAI's government contract work was deemed mission essential and continued even during the recent U.S. government shutdown. This confirms their non-discretionary role in national security and provides a degree of revenue stability that many commercial contractors just don't have.
And finally, we measure their future potential through their backlog. How does that look?
BBAI currently holds a substantial $376 million backlog as of September 30, 2025. This represents the total value of contracts awarded but not yet executed. And while this looks robust, it provides comfort only if those contracts convert reliably to cash.
And that's the big question. So we have now established the central conflict of the BBAI investment thesis, a massive strategic opportunity and a massive war chest on one side, battling severe financial weakness and high costs of capital on the other. Given the low structural margins and that recent 20% revenue collapse, does the strategic capital raise justify the high valuation?
That is the decision point for every investor. We need to clearly synthesize the bull and bear cases based on the evidence we've laid out.
Okay, define the bull case for us.
The bull case rests on the forward narrative. They have a massive, fully funded $715 million capital war chest. This cash is being used to execute a vital, transformative strategic pivot, symbolized by the $25 million Ask Sage ARR, that's high-growth, high-margin software revenue that accelerates BBAI into the Gen AI platform space. This timing aligns perfectly with the multi-year $16 billion OB3 tailwind for military AI autonomy.
So the argument is that the pain now is worth it.
The bull thesis argues that the dilution is a necessary one-time cost to buy the technology and talent needed to transition from a low-margin service contractor to a high-margin software platform.
And the counter, the bear case. What are the current operational realities telling us?
The bear case contends that the strategic bet is simply too expensive and that the company's underlying operational structure is too weak to sustain the effort. This weakness is undeniable. I mean, it's evidenced by the severe 20% revenue decline, the swing to negative $9.4 million adjusted EBITDA, and the structural low margins, 22.4%, inherent in their service model. The bear case argues that the massive dilution is being used not just for growth, but primarily to mask and fund deficits in the core shrinking business.
So if we look at the financial reality, the ultimate outcome hinges entirely on cash conversion and the resulting rate of future dilution.
That is the core of the financial conclusion. We have to look at their cash flow drain. The company has trailing 12 months negative free cash flow of $42.42 million. Despite that huge cash pile, they are demonstrating persistent, deep negative cash flows from operations.
And what are the implications of a $42 million annual cash burn combined with a low structural gross margin?
The implication is a high risk of continued reliance on external financing. The combination of sustained operational cash burn and the structural constraint of low gross margins means the company faces a high risk of continued reliance on equity raises, dilution, to finance future growth, working capital, and potentially future M&A.
So this dilution is not a one-time event.
No, it's a structural necessity under the current model. This persistent dilution, which is required for management to maintain its offense strategy, will persistently suppress future share price appreciation, regardless of how successful Ask Sage is, until the company can organically generate sufficient cash flow to cover its investments.
The market simply cannot fully value the strategic upside until the Ask Sage integration proves it can drive sustainable, scalable, high-margin profitability that successfully reverses that TTM negative cash flow trend.
And before we conclude this deep dive, there is one final provocative point for you, the listener, to consider linking back to that backlog.
Okay.
We noted BBAI's high customer concentration, 52% of their 2024 revenue, came from just 4 clients. Now, government contracts, which make up the vast majority of their substantial $376 million backlog, include prevalence of termination-for-convenience provisions.
Meaning the government can cancel or modify the contract at any time without penalty, essentially.
Exactly. So given this high customer concentration, the structural low margins, and the ease with which the government can cancel contracts, how truly reliable is that current $376 million backlog in actually converting to future revenue? And what does that mean for their persistent need to raise cash through dilution? That is the ultimate test of their financial stability moving forward.
A question that puts the reliability of future earnings into sharp, painful focus. Thank you for guiding us through this very challenging financial investigation into BigBear.ai Holdings.
Risk defined, portfolio protected.